Joining me now is investment consultant Ray McGrath from Cammack Retirement Group. Ray, let's talk about some of the latest trends with defined contribution plans. The SEC issued money market regulations. What's your take on some of these new rules? I know you're doing a lot of due diligence on these types of funds and products, and you're learning a lot about what the SEC has in mind.
I think we're all well aware that money market regulations go into effect October 2016. But what we're not aware of is some of the issues that the record keepers are running into in terms of being able to implement some of these new rules. The way the rules are set up is that if during periods of uncertainty there is a liquidity or redemption fee that needs to be implemented by the mutual fund company, the mutual fund company can determine that they want to implement these rules midday, say 11:45 in the morning, and then all the participants in the funds would be subjected to these rules. That's a problem.
Yeah, I think today the NAV is struck on a night-by-night basis, and most of the record keepers are set up to do this type of trading. They don't trade in midday. I mean, it's a rare exception that a record keeper can trade like an ETF during the day or do this midday trading. So you're perceiving this as a potential issue and a due diligence matter for plan sponsors.
It is. What we're seeing is that record keepers want to no longer offer a non-governmental money market fund. They in turn want to offer a governmental money market fund, albeit lower yielding, sometimes 10, 15 basis points historically, government money market funds. But they want to offer that fund not because it's the best solution for the participant, it's because their record keeping system cannot record keep some type of midday occurrence, you might say, redemption fee or liquidity gate.
So this is really a fiduciary concern because from a fiduciary perspective, you and I work together on several clients at Cammack. We are really bringing ideas and solutions to clients, and we bring fiduciary matters. If the plan sponsor needs to think about what fund is appropriate for a particular asset category, not necessarily be in a position to put a fund in just because it's convenient for the record keeper. So I imagine that you and your team will need to do a lot of due diligence on these types of products and also present alternatives. Is that a true statement?
That is a true statement. Because a majority of the record keepers are not fiduciaries, they're not even able to quote unquote recommend that you move from a retail money market to a government money market fund, because that would be considered advice. So the participants or the sponsors, they need some assistance here. What we're seeing, some of the record keepers are offering their stable value solutions, and that brings a whole nother set of circumstances that needs to be evaluated by a committee. And in theory, all of this has to kind of happen soon because the regulations are going into effect in October. You're looking at, committee schedules and things like that. A decision probably has to be made mid-summer or early summer.
Right, and the record keepers, there's very clear stipulations about when funds can be added, how they're added, the mechanism to communicate to participants. We've had numerous conversations with clients and on the road when we're together on the train talking about the importance of communicating to plan participants. This is another issue. Participants are bombarded with information throughout the plan year. They're bombarded by fees, they're bombarded by general plan communications. This is one more thing that's got to be filtered and understood. Though it's probably being done in the best interest of the plans and the participants because of what happened in 2008, it's really important that plan sponsors take a step back and think about how they're going to communicate this. So I would imagine in your estimation, you're going to bring this up in committee meetings now and through to October of next year.
We are, and we're seeing more and more record keepers. They haven't all finalized or publicized what their solution is. Some record keepers can, especially the record keepers that offer their own money market fund, they have the functionality built into their system. It's the record keepers that don't offer a money market fund and aren't set up to trade this way or to implement these rules or regulations.
And, the clients with whom we work across the gamut, right? Large, small, but also higher education, healthcare, governmental, corporate. The issue is still the same. Do you include a money market for capital preservation? Do you include it along with a stable value or fixed annuity fund? You're creating new lineups today for plan sponsors. You're reevaluating those lineups on a regular basis. What trend are you seeing? Are you seeing the collaboration of money market and stable value in lineups that you're creating?
When typically the stable value funds do not like to see a money market fund coexist in the lineup because it's a competing fund. What stable value funds like to see is if there is a competing fund, and typically competing funds are defined as any fund that has a duration of 3 years or less. So a short-term bond fund, a money market fund, exactly. Those are all funds that would be considered a competing fund. when you have a competing fund, you cannot move seamlessly between the stable value and the money market fund. Typically, there's what's known as an equity wash, where if you want to move from stable value, you have to move to a longer duration fixed income product or an equity fund for 30, 60, 90 days, all depending on how the stable value contract is written. And after that period, then you're free to move to the money market or the stable value fund. So there's issues there as well. It's not as seamless as you might think. The other issue related to it is, if you do adopt a stable value fund, in some ways you're tied to that stable value provider. That might not be a portable fund that can go to other record keepers. So in some ways it might make you a little bit sticky as it terms related to that record keeper. So you might have you might not be as flexible going forward with your options.